Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of LKQ Corporation. So let's get started. Now, for context, LKQ Corporation, which stands for Leadership, Know-how, and Quality, which is an awesome little acronym, is an American provider of alternative and specialty parts to repair automobiles and other vehicles. And they operate in the US, in Europe, and Taiwan. So basically, if you want to repair stuff, if you want components, and all sorts of stuff for a car or an RV or something like that, LKQ is someone you may possibly deal with. Now, looking at the long term here, from 2014 all the way till 2023, their revenue has been just steadily growing at the end of the day. Even with that blip in 2020, it seems like they're a very reliable revenue grower. On the other hand, net income is also growing, but it's staying pretty consistent, and so is free cash flow, at least compared to the revenue. Free cash flow is something that in the long term has grown, but it's always a certain small percentage. And that's kind of normal. I mean, you have a business that makes parts, that makes things, the cost of manufacturing is going to be very high, of course. So the optimizations may be a little more there, right? And that will reflect down at the net income level. But that is just to be expected. That is the nature of the business, that the free cash flow and net income margins aren't going to be that high because the cost of manufacturing and add on the cost of marketing and the cost of other things is already going to be pretty high. So in the first quarter, the revenue is up. The earnings per share are down. I don't care about earnings per share personally. That has to do very little with fundamentals and a lot with just how many shares they either issued or buy back. I don't care about that. What I care about is that their revenue went up compared to the previous quarter, which looks pretty good. And their operating results in general, well, the revenue is up and the gross margin is up. As I said, their efficiency is going to be reflected in the way that they can manufacture more for less cost, and that overall seems to be okay. However, operating expenses and by extension operating income all the way down to net income is down. Now, some of this is because of more taxes, some of this is because of just other things, operational inefficiencies, but at the end of the day, the top line is pretty good. The bottom line, not as good, but still positive. Okay? So, we also see the capital allocation here, where here they have the beginning cash, operating cash flows. They issued euro notes, so they issued debt. They repaid some of them, capex, acquisitions, debt payments, and here you see how much of a drag actually debt payments are, where the operating cash flows, the cash money that they received were $253 million. Subtract the capex and then subtract debt, and already you have almost like a negative balance here, not including obviously the debt that they issued. But yeah, I mean this repayments of debt, the repayment of euro notes here, the repayments of other debt is such a drag on what they could do with free cash flow, and that's just something that is a great visual of just how much money it takes to pay interest. They also have a dividend. They repurchased a few shares and then ending cash, they do have a little more, but most of it is because they issued those euro notes. They issued debt in the long term that will finance their activities in the shorter term or until then, which hopefully will yield more. And hopefully, you as a shareholder are getting more than they will eventually have to pay for that debt, of course. And that's where, for example, inflation, you gain on inflation because you issue debt for way later, and that debt will be worth less because you're paying with tomorrow's money. So that's important. Now, operating cash flow has also been pretty okay, and free cash flow has also been pretty great. So they seem to say it's going to be here. There where the EBITDA is going to, the free cash flow is going to be around that 50 to 60% of adjusted EBITDA. That is about in line with previous years, maybe a little down, but not significantly so. So that's cool. I mean, they're basically saying business as usual for us in terms of free cash flow. Now, the liquidity, so the debt to EBITDA is about 2.3 times. Why is this important? Because if the debt to EBITDA is too high, in the case that they liquidate, they first have to pay the banks, they first have to pay owners of senior debt, and then if anything is left over, then the shareholders get anything. So you want a lower number, hopefully below 3, maybe even 2.5, to just say, okay, we're good. This level staying consistent, that is good, but you have to keep a watchful eye. Now, here is all their liquidity. So they're talking about what they can do to pay down their debt or to issue debt in favorable terms. They have investment grade ratings in Moody's, in S&P, and in Fitch. So far they can take out debt with more favorable terms than other companies. They have some fixed rate investments, variable rate instruments. I mean, it's great because I feel like more companies should be showing you this. They shouldn't just be saying we have X amount of debt and this is repayable here. They should show you the actual structure of everything. So here, you can just comb through this and see if you're comfortable with it. At the end of the day, they have favorable terms for their debt, although at the end of the day, they also have a lot of uh, a lot of net debt because the cash is not enough to cover it. The free cash flow is not quite enough to cover it either. It would take a few years of generating cash to pay down the debt fully. So we are going to do a model, a quantitative model here. What we're going to do is first we're going to compare how much of revenues, what percentage of revenues get turned to free cash flow. Historically, it averages about an 8%. I am going to roll with this number. I'm going to say, you know what? It's 8% of revenues that get turned to free cash flow. So we're going to forecast revenues. For the current year 2024, if you go to Yahoo Finance for LKQ, go to the analysis tab, you can see analyst estimates. I'm going to grab the low bound of these estimates just to be conservative. And they say that in 2024, they're going to make $14.98 billion. In 2025, they're going to make $15.54 billion. Cool. Let's roll with those numbers. And then free cash flow is going to be 8% of that. So plug it into the model here, where my only other variable is basically the required rate of return, which for me personally is 11%, 1% more per year than the market in general. And it's also going to be 2% perpetual growth rate. So from 2026 onwards, we're growing LKQ by 2% and 2% only. Now, divide that by the total number of shares out, you get a fair value of equity of $50.69. However, if you subtract the net debt of $5 billion, then the fair value that you get is $30.94. Okay, let's take a look at the value of LKQ. Interesting. So it's $41.45 as of the close on July 5th. This is pretty much smack dab in the middle here, with the fair value post debt being $30, the fair value pre debt being $50. You have it smack dab in the middle. Now, what do you do when you have something that's very much in the middle there? You take a look at the terms of the debt, which is why I included that slide. It's basically saying, okay, do we care about the debt? Is the debt in very favorable terms? Or are they able to re-roll that debt into the very, very long term, which more or less they are? And are they taking a significant chunk of their flexibility out with the amount of debt that they have to repay? That's the other big question, which is why I wanted to show visually all of that. In general, I think it's a mixed bag, which is why I feel like this valuation of 30.94 is fair. Here they have a P ratio of almost 14, 13.5. They have a dividend yield of 2.9%, a market cap of 11 billion. Remember, they have $5 billion in debt, so that's a lot even compared to the market cap. So overall, I think LKQ looks like a great business in the long run because at the end of the day, they are a consistent revenue grower. They are a consistent free cash flow generator. People will always need to repair their automobiles. Even you can say the electric transition, blah blah blah. Yes, absolutely. But they will just make parts for electric cars, for electric trucks, for electric vans, etc. The balance sheet looks really, really good overall, but the amount of debt will still make it a little less flexible than if you can find a peer that has a similar financial situation but less debt. So it looks about fairly priced to me. My assumptions are conservative. If you think they're going to generate more revenue, if they're going to grow by way more, then it's probably worth it. But that's if you personally don't mind the debt and think it's going to grow way more than I thought. At the same time, do you think it could go to a 30s level during a tough quarter? Because I personally do. If it's very tough, if all of a sudden the growth looks very shaky, then it will go down to the 30s easily. And that's where I would be super interested. So I would always say, ask yourself, what's the downside? Sometimes you're looking at these presentations, which is companies selling themselves, right? When you're looking at earnings calls, at reports, and they're saying, hey, we're doing great. And you even have to ask yourself as you're reading all of this, what is the downside? The downside here is potentially that the debt is going to be less flexible compared to a peer that could give you more of a dividend, more of share buybacks, etc. And the other downside is simply that in a downturn, it could still take a hit. So buying it at 30, for example, if it's going to go to 60, is way more of a gain. It's 100% of a gain than buying it at 40, which is 50% gain. So that's where the price matters. Valuation matters, and it matters a lot. Now, thank you so much for watching. I really appreciate you taking your time. And If you want to see more videos like this, please comment down below. Tell me what stock you want me to analyze. And don't forget to like and subscribe. With that said, thank you so much and have a great rest of your day.